our guests, Hilary Kramer and Jessica Menton, talking about the end of the trading day, down about 580 points. Hilary.
Okay, so it's not as bad as it could have been, but at the same time, most traders would have talked to, they would have bet that we actually could have been green at the end of the day. I mean, it really was looking good. That turnaround was really excellent. And the fact that we ended, not on the lows, but kind of midway in there, it's not a great sign, but it still doesn't mean that necessarily tomorrow is going to start on a down note.
Right.
The important thing for the U.S., though, I do want to point out the energy stocks. We really need to talk. Exxon Mobil at a 52-week low, Chevron, ConocoPhillips, and then hundreds of other stocks that in all of the different indices. Why is this important? It's important because as these energy stocks continue to fall and the price of oil under $40 a barrel, this is problematic for certain swaths of the United States, Texas, North Dakota, South Dakota, Oklahoma. So I do want to see, we need some firming up of these commodity prices. Unfortunately, supply just continues to increase. So even when we see demand, start to rise, the whole game has changed. We're clean tech energy, again, supply, and we've become more fuel efficient in many ways. So I think every investor should be thoughtful that way and know that, yes, the good news is we can put gas in our tank and have a few extra dollars.
For us at the pump, but not necessarily if you're investing in that sector.
Right, exactly.
Jessica.
And to your point, talking about that volatility, just in the first 90 minutes of the open, we saw the Dow move up and down 3,000 points.
Right.
That's quite dramatic there. And traders that have worked on the floor of the New York Stock Exchange since the 1987 crash were telling me they haven't seen this type of volatility, so much pendulum swings during their time, and they've been there for decades. So it's quite astounding that they would make that kind of statement.
But a lot of these companies, a lot of the stocks that we've seen, and in fact the stocks that are in the Dow right now, I was looking at some of the gyrations that were happening, they're still up from, their highs, they're still up from their lows.
Absolutely.
They are doing
Okay, so when you look at our stock market, the beauty of the American economy, the beauty of the U.S. stock market, we have created since the 2008-2009 crash entire new excellent sectors. Cybersecurity, we're the best there are. There's the old world companies, like Raytheon, but we have all of the new companies out there like FireEye, F-E-Y-E, that have come and risen to the call of the need, given all the cyber threat. Data mining is a big industry.
Data mining is, it's interesting. I've been looking at some of these stocks that we used to call rocket stocks when I worked on the street, right? These are stocks that have short-term catalysts but can provide some real long-term growth. And a couple of the stocks that I looked at that I think a lot of people are interested in right now are still healthcare. Healthcare has had a tremendous run since 2008. And the companies within that sector continue to innovate. Is that a bright spot for investors?
I think so, especially after we saw what went down with Obamacare. After that, at the end of June, they've continued to take off since then, and they've rallied for a couple of years now. And so I would think, even though we've seen these dramatic type swings recently, that's probably one of the best sectors that wealth managers have told me to be in.
Right, exactly. So the biotechs have made investors very nervous the last few days.
They've had a tremendous run too, but with that risk that goes along with investing.
That's right, but these traditional healthcare stocks, it's still a great place to be. You can never do wrong being in J&J, in Merck, even some of the biotechs that are kind of that have therapeutics that are applicable now. Regeneron, REGN, macular degeneration, and a actually blockbuster cholesterol reducing drug. So there are still those opportunities. And if investors are looking right now and you have extra cash to deploy, I think there's some real safety in some of the big financial institutions. JP Morgan.
I was looking at JP Morgan today. That stock is $2.6 trillion in assets. These new government regulations with these capital requirements mean that we're not, a lot of people were saying this morning, we're like back in 2008. And I was like, I don't see any of the similarities that I saw in 2008.
There isn't $7 trillion of this insurance that's been written against mortgages. We don't have anything like that. So much of the regulation that was put in place and that so many in financial institutions complained about are going to save us and get us through. We could certainly end the year higher, and I wouldn't be surprised. For those that are careful with investing and have money set aside, this is a time you can go out there and buy and find some value.
What do you say to that, Jessica?
It's interesting, too, because everything that's going on now also affects what the Federal Reserve is going to do. Everyone was expecting September is when they're going to lift rates in the first time in almost a decade. They've been at historic lows since the financial crisis. And this changes the game now. The tone has changed when I talk to the analysts and traders on the floor of the stock exchange. They don't think it's going to happen. And when it comes to the Fed, that it impacts consumers, whether it's mortgage rates, 0% financing on credit cards. But if you look at sectors, say the financial sector, they were the ones that were going to benefit from this, but this might not happen just so soon yet. But then you look at more sort of cyclical sectors like utilities. That's usually better if interest rates are still at lows. That's good for those types of sectors as well as telecoms.
Now, the thing that a lot of retail investors who are watching us, they're not traders, they're not looking necessarily at individual stocks the way we've been talking about. So for them, the message has been all day, we've been hearing from financial advisors, a well-balanced, well-diversified portfolio is key when riding out volatility like this, because no matter what sectors you're in, there will be offsets based on how diversified your portfolio is, Jessica.
Absolutely, and especially when you see what has been happening in China's stock market. If you have a traditional type portfolio where it's 60-40, 60% exposed to the stock market, 40% to the bond market, it's actually 5% of that is to emerging markets. And out of the 5%, 1% is to China. And that's not exposure to what we've been seeing in the Shanghai composite, the dramatic drops like we saw the 9% earlier today. That's in the Hong Kong exchange. So you're not going to have those types of swings in your portfolio that you might think if you turn on the news and you're wondering, oh my gosh, what's happening with my 401k right now?
Right. In fact, as I was waiting for you guys to come on set, I looked at my own portfolio and I'm down maybe like 1%. And that's because my portfolio is very diversified. And, I'm going to, give my age out here. I'm 45 years old. I have another, hopefully, 20 years of working. And so I'm not going to need this money for a long time.
And that's the way investors have to look at it. If you combine a long-term perspective and think of it, it's like collecting wine. I mean, you just want to keep it and watch it grow and think of it as that kind of opportunity. For example, you could buy a company like Under Armour today, UA. People don't really take Under Armour seriously. That's going to be a major retail stock one day in terms of, just new innovation in terms of athletic wear. Nike still has a lot of strength left in it, an opportunity there. Every investor should look around at where they go, what they eat, where they spend their money, and you should think about investing in that way. The great thing is that the equalizer has been the internet. Years ago, you needed just your stockbroker, and your stockbroker made the decisions. He'd hang up on you if you told him you wanted to buy Priceline
He'd
stock.
tell you to stop reading the newspaper.
That's right. But today, if you go to Texas Roadhouse for dinner tonight, TXRH, and you say, gee, this is pretty good, and I got out of here with some drinks and for $20 and a steak, maybe you want to buy that stock and enjoy the dividend yield to that. No, you don't have exposure to China either.
Yeah, Jessica, so today, this is Monday. We've got all week to go. This has been a crazy ride today. What are we expecting overnight from the markets overseas, and what could we see tomorrow here in the U.S.?
Well, it seems as though we're probably going to see more volatility, but it also depends on what we're going to see with the Chinese government. Are they going to step in? Last Friday, we saw a tremendous amount of volatility, but the government didn't step in, and that's what created even more fear. And so maybe if they come in to try to prop up what's going on, maybe that could ease concerns, but we're going to have to wait and see overnight what's going to happen.
And I find it really fascinating, too. I mean, we've been talking, there's sort of two ways to look at this, right? One is the individual trader who's looking at some opportunities in the market and perhaps says, as you point out, there's great companies in the defense sector, Raytheon, for example, General Dynamics. A company that I really love is Reynolds American Tobacco. I know that these are one of those sin stocks, right? Nobody wants to talk about sin stocks, but they own 32% of the market, and they are, and yes, the tobacco industry is slowing, but it ain't slowing that much because people are still out there smoking, and they're doing very, very well.
Oh, that's what a great point. You can also apply that to looking at a company like Hewlett Packard, HPQ. Yes, I know we're not selling printers. People don't even have printers anymore. It's the same as the tobacco stocks.
Right.
But you know what? You could double your money at Hewlett Packard. You have a CEO like Meg Whitman there, and they're growing their enterprise business. They're going to do a split. They're going to split into two different segments. So anyone who has Hewlett Packard gets two stocks in the coming few months. Yes, look in those places that you never expected, and you can really make some money.
And then, Jessica, for people who just have mutual funds, they're not looking at individual stocks, they have mutual funds, there's still some opportunities in the emerging markets, even as we see the volatility, because, A, you shouldn't have 100% of your portfolio in emerging markets. If you've got 5% or 3%, that's enough, and over the long term, that's what it's there for, right? To provide a little sweetener to those more conservative portfolios.
Just last week, we saw $8 billion move out of of our equity market into mutual funds, and that's
$8 billion.
$8 billion. That's an astounding number there. And there's also quite a bit of an exodus from the emerging markets, but that also creates, during times of uncertainty, there's buying opportunities. And I think that people should remember that during these sort of times.
The other thing that I think is always forgotten is when we say to folks, you know, look, this is not a moment to get panicked. You should stay where you are. If your plan is to retire, if your plan is to put your kids through college, stick to that plan. The other one is the rebalancing of a portfolio, because as things get out of whack in a retail investor's portfolio, there might be a tendency to say, look, this is a great buying opportunity, I'm going to keep buying. Or they're going to say to themselves, look, I want to pull some things out of it. But you have to rebalance that portfolio to make sure you're at the optimal investment, doing the best thing that you can for your bottom line.
That's right, and there are so many investors, let's say, who have, maybe their stock was at Apple, and as Apple grew and grew, they weren't rebalancing and thinking about, maybe I need to pare that down and be more diversified and think about, you know, sectors, and that's where mutual funds can come into play, ETFs, but generally, it's whatever an investor is comfortable with, as long as you're not leveraged and you're not borrowing money to invest. It's a dangerous game because you can be right, but if you borrow to invest, you have to be right in time.
Right.
And
very
that
difficult.
doesn't
very
happen.
difficult. And that's something that I think, you know, we want to mention to the viewers that are watching this. You know, we'll look at a market like today and we'll say, wow, down 3.5%. That's a serious gyration there. But the reality is people should not be freaking out over every single market movement the same way an institutional, because they're not freaking out, generally speaking.
Right, no, just look at today. The reason that we saw so many dramatic swings just in the first 90 minutes is because you had hedge funds and institutional investors come in and trying to buy.
I had that feeling. I could feel that out there.
That's exactly what was happening there. And so it's important to keep that in mind. And also, we've had such a run-up since the financial crisis in this bull market. We haven't really had any sort of proper correction since about 2011. And it is healthy to see a bit of a pullback so things aren't overvalued. And I think it's important for consumers and investors that are watching the news and are thinking, should I freak out about this in my money, in my 401k, to keep that in mind.
So this is now, I'm told, the 8th biggest loss on points of all time, although percentage-wise, it doesn't even crack the top 20. I don't have the exact number in front of me here. But here's the thing, too, that I find fascinating about investing is counterintuitive for a lot of people because you combine two very different emotions. You have the fear factor and you have the greed factor, right? The fear factor is, look, this market is going down. I don't know what to do. What should I do? And a lot of people decide to pull their money out at moments like this, which is exactly the worst thing to do. On the other hand, when the market is going up and up and up, and your financial advisor calls you and says, hey, listen, we should take a little off the table, people say, what, are you crazy? I'm making money hand over fist. And that's a difficult thing that investors have a hard time understanding.
Right. Wealth creation, real wealth creation has been made when the market's down, when there are opportunities like this. What do they say? You should buy when there's blood in the streets, you know, not be running away from the market. So the point is well taken, and investors have become so spoiled. And I think even though our fundamentals are so strong in the U.S. economy, we have to admit that the Federal Reserve did turn on the printing presses and just printed money. You know, they brought down rates to 0%. So to some extent, we've become spoiled by the fact that there was some manufacturing here of the lack of volatility and the rise in the market.
So the Fed does bear a little bit of a responsibility for what we're seeing right now, Jessica, not just China, but the fact that there's been some cheap money.
Yes, absolutely. And it's interesting because they got out of their quantitative easing program last October that they made to stimulate the economy finally after the recession. But it's interesting that we did see a lot of volatility last October and in December, but then after that, not too much volatility until now. And a lot of people thought after their first rounds of QE ended, it was way more dramatic if you think back to 2011 when we were in another situation where Greece isn't going to leave the Eurozone. It was in a debt crisis, and then the U.S. was downgraded, their debt rating, by the S&P. And there was a lot of volatility then, too, and then the Fed came back in a couple months later, stepped it up with QE2. And it's interesting that the last year we just haven't seen that type of volatility up until now, and I think it really is because of that fear of, is it a global slowdown? And it's a question mark on China because it makes you wonder, what is their growth rate really right now? And we don't know.
We don't know. And the question I'm wondering is, has the Fed, are they backed into a corner now? Because a lot of people have been saying, look, in September, they were probably going to do a little easing. Maybe they're not going to now.
See, the Fed won't. There's no way the Fed can
now.
No, the Fed can't tighten now. So first the Fed, they were concerned about employment. And now unemployment's at 5.3%, even though what we really care about is labor participation, which is very low at 63%, of our population. Then suddenly, when that was taken care of, the Federal Reserve said, oh, wait a second. You know what really matters? Inflation. That's what we're going to watch. As long as there's no deflation, there's some inflation, then we're going to start to tighten. Well, the reality is we actually really do have deflation. We have wage deflation. Wages haven't grown. So what has grown, the inflation the Fed is looking at is the inflation they've created through a housing bubble. Asset prices are incredibly inflated, on everything from art to wine, for example.
For sure.
But in reality, we really have had a wageless recovery, and the formerly wealthy, is a class that exists now. I'm a formerly wealthy. There is no more upper middle class. There's really not much more of a middle class that existed before 2008, 2009. So although, especially when you compare our economy to the rest of the world, we're strong, we have the right factors in place, we have the right kind of government in the sense that we can forge ahead and continue to spur on innovation.
Right.
It's still a rough time because people aren't making money.
Right, so that means so if they're not going to do anything in September, I don't even see them doing something in December, raising rates in December.
No.
Probably not, and the only reason it was September or December was because they both are accompanied with a press conference. The October meeting isn't, so you wouldn't think they'd surprise us and go in October, and then, hey, what are you going to tell us about this?
There's no point.
Exactly.
If the Fed goes and tries to tighten right now, it's just going to be really dangerous. Our dollar is going to get stronger, which has been a real problem, of course. A strong dollar unto itself, I'd rather a strong dollar than a weak currency. But in this case, I mean, you look at our companies from Coca-Cola to Caterpillar to Deere to Boeing, they have all struggled through earnings. And that's another reason, though, why, here's the bright spot. Next earnings season starts in October, September 30th, the third quarter ends. And because the dollar at least has stabilized, it's even been a little bit weaker, I mean, very minorly, but a little bit weaker, it's going to so much help the earnings of so many companies that have struggled. Certainly everyone uses Procter & Gamble as the example, but, all of them. Clorox, and the big drug companies, Johnson & Johnson as well.
But profitability has been up, and they haven't really, in other words, the profitability of these companies, that's part of the reason we've seen such a tremendous ride in the market.
Absolutely, and then the downside of that is what we've seen, especially over the last 3 or 4 quarters, is because of that stronger dollar, companies are hurting when it comes to revenue. Their sales growth. So a strong dollar sounds good for us because of purchasing power, but it's not exactly good for bottom lines, right? Exactly. So if you're especially in the technology sector, which is probably why we're seeing a lot of swings now, but when it comes to, say, your Intel, Qualcomm, around 80–90% of your sales are coming from overseas. So if you convert that back, you're losing money. And we've continued to see that sort of headwind, especially also when it comes to oil and what's that done with energy companies as well. But as far as the Fed, the two things that people were telling me were they are going to hike in September unless we see our unemployment rate go up, or if somehow we see tightening in our stock market. And before we saw tightening in China, not over here, but now we're seeing it here. And so that is why the tone has changed. And it could be off the table for this year now.
Well, one final question I want to throw at both of you. So as we've seen the markets climb ever higher over the last couple of years, a lot of people have said, you know what, this market was overvalued. And no, I didn't like it. I didn't like Apple at 105. I don't like it now. I want it even lower before I decide to step back in. Is that the right call? Or is it, look, the economy is strong. Interest rates are going to remain where they are right now. This is a blip caused by pressures in the emerging markets. We should still be looking at higher numbers in the days and weeks ahead.
I want to look over the years, and if you look out and say, I'm going to be holding these companies 5 to 10 years from now, yes, you want to be invested. And I still stand by, my theory is in December, we're going to see a higher Dow, S&P, and NASDAQ. But do know that some companies, Netflix in particular, Amazon, Gilead, 6 companies were responsible for 50% of the gains of the S&P 500 this year.
Right.
6 of them. So the answer is there are lots of great opportunities in this market, but they're not the obvious companies you're thinking of. You can go out there and find money. It might be a company like a Cisco. You know, it could be even GM and Ford look attractive here. American Airlines and Delta had a bad day. There's nothing that's going wrong with those companies fundamentally. Get in there, you know, and buy the opportunity stocks.
Jessica.
Absolutely. Talking about those momentum stocks like Netflix, it's gained well over 100% just since January, and it's the biggest outperformer on the NASDAQ 100. So when you look at those momentum stocks like that, Amazon and others, of course they're going to have that dramatic run-up, and so maybe they were a bit overvalued, and so they needed a bit of a pullback. So even whatever losses it's had in the last few days, it still has gained well over 100%.
You're just trying to catch a falling knife. You don't want to do that, but if you buy McDonald's here, MCD at 94, you're going to get a great dividend yield, and you can't go wrong short-term or long-term.
Yeah, it's interesting, too. You know, we've talked about Warren Buffett and the kind of investing that he does, and he's always looked at these, like, sort of these brands that people don't find them sexy at all. And there was even, I was just talking to a guy earlier today, and he told me I should look at Equifax, which is a company that if you use a credit card, Equifax knows about it, right? They are the ones that provide those credit scores, and Equifax is one of those companies that is going to continue to do well. This is one of the top companies in that sector. And he said exactly what you're saying. There are opportunities in this market. They're just not the obvious ones.
Right, absolutely. You have to kind of know where to look sometimes between everything that's going on. Sometimes the most popular ones might not be the best ones, those momentum stocks to get in.
And when all else fails, leave it to your portfolio manager if you're invested in a mutual fund, because a lot of people are going to try to do this. You guys are the experts. A lot of people are going to look at what we're talking about and say, hey, I should maybe go out and do something as to what they said. I should go out and buy Raytheon. We're not saying that. We're saying that, you know, you should keep to a well-diversified portfolio and talk to your financial advisor to figure out what is the best thing to do for you.
Absolutely.
All right, Jessica Menton, Hilary Kramer, thank you very much, both of you. Appreciate it.